All right, Aaron, stick around. We have some money advice for you this morning. In our Raise Your Credit Score segment, we're talking about the difference between good debt and bad debt. And joining us this morning is Anselmo Moreno. Good morning. Thanks for joining us.
Good morning.
Let's get right into this. Good debt versus bad debt. First, let's start with what some good debt is.
Well, good debt is always like things that will build long-term wealth, like a mortgage. That's always considered good debt because you're going to have to pay for housing somehow.
Okay.
But when you're owning a home and then you're doing it the right way with low interest rates, then that's considered a good debt. And so is like financing and education. When you're financing something that's going to produce income in the future, it's always going to be good debt. So student loans can be good debt. And also automobile loans. And these are directly related to how your credit score is. So if you have a good credit score, you're going to tend to acquire good debt because you're going to get cards or money at a lower interest rate. So it's very important.
Okay, what about some bad debt?
Well, bad debt are things like a credit card that are very high interest rate that you finance a pair of shoes on and 5 months later you still haven't paid it off. That's bad debt.
Did you know about those shoes that I just bought? Thanks a lot, Anselmo. Okay, so credit card and also buying a car can be a bad debt as well. And is that for people who have bad credit scores?
Yes, people who have bad credit scores have a hard time getting out of their bad credit score rut, if you will, because they keep getting into higher and higher interest rate loans, like payday loans and check advance loans. And those aren't very good to get into.
So if someone does have bad debt, or if they do want to get a car and they don't have a very good credit score, what should they do? Should they start saving so that they can buy a car?
They should start working on improving their credit score because we see consumers who have a $500 payment on a $10,000 car, and those numbers just don't make sense unless they're paying 20% interest rate, and it's just something that they're never going to be able to get out of. So, people have a need for a car and they just kind of jump on it when they get approved for financing, but you have to be very important. Bad debt and good debt is always revolving around the interest rate, so be very conscious of what your interest rates are that you're paying on.
Interest rates for mortgages right now, very good. What about interest rates for cars?
And those vary based, on your credit score. So each bank will have their own rates and they'll have a rate sheet, and your X credit score gets you Y interest rate. So it's very important that you do your research.
Well, about 2 years ago they weren't loaning to too many people with a very low interest rate. So are we seeing that change now as the economy is starting to recover?
There is, but most people don't get very favorable loan terms. And so it's very important to do your research on how long and how much it's really going to take you to pay off the car if you finance it at 17%, whether if you wait a few months, improve your score, and you finance it at 7%.
Okay, wow, 17% and 7%, that's a very big difference.
Very big.
Anselmo, thank you so much for joining us. If people have any more questions for you, where can they find you?
They can call us at 377-1861.
Okay, and the name of your company is Innovative Credit Solutions, is that right?
Correct.
Okay, wonderful. Thank you, Anselmo.
Thanks.